Hey everyone, in this video, I'm going to highlight my top dividend stock to buy for 2024. Now, dividend stock investors could have a good year in 2024, given that the central bank in the US has signaled it will decrease interest rates several times. Why is that good news for dividend stocks? Well, some investors that are looking for passive income right now have an attractive choice in government bonds. If government bond yields decrease, that could make dividend stocks look more attractive. Regardless, I like this dividend stock whether the Federal Reserve decreases or keeps interest rates the same. So let me share with you what this dividend stock is and why I like it so much.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the dividend stock that I'm recommending as my top dividend stock for 2024 is Visa. Visa offers passive income investors a dividend yield of 0.72%, but I'm going to share with you in a little bit why I think passive income investors can reasonably expect this to rise over the next several years. The dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. That being said, you can see Visa's payout ratio is only 21.72%, indicating that Visa's dividend is stable, sustainable, and has an increasing likelihood that it will increase its dividend per share over the next several years and for the long term. Visa's revenue over the trailing 12-month period has increased substantially over the last decade. You can see at $32.65 billion in the most recent trailing 12 months. That's up from around $12 billion in 2015. What's more, there are more than 4 billion Visa cards in circulation today. Visa has spent decades building this network, attracting merchants that accept Visa cards and customers that have Visa cards. That network, that decades-long establishment of that network is a strong competitive advantage for Visa that's likely to support revenue growth for several years, if not several decades more. Visa's operating profit margin is the best out of any of the companies that I follow at 67.15%. More impressively, Visa has sustained this elevated operating profit margin for the last decade. You can see it's actually increased from 62% in 2014 to 67.15% as of the most recent update. When you have an operating profit margin of over 60%, which very few companies do, maybe 2 or 3 companies that I follow out of more than 100 have this kind of operating profit margin, it invites competitors to try and take your market. And so by demonstrating an increasing operating profit margin despite this extra high level, Visa has demonstrated to investors, to me, that it can defend its market, that it can defend this lucrative market. And that's crucial. That's something that I look for when I'm looking at a company. Not only does it have an excellent profit margin, but it has defended that profit margin for a long time. That makes me feel that it can continue to do that over several years more, that it's not going to get overtaken by competitors, and this isn't a short-term peak or something that's going to reverse downward after I make an investment. And so that's something that has attracted me. In fact, I don't think I've said it yet in this video, but I own Visa stock. I've owned it for a while now, and these are the reasons why I've been attracted to Visa stock and why I plan on holding Visa stock for the next year, for the next several years. I don't see myself, unless there's some substantial change to the business, I don't see myself looking to sell Visa stock anytime soon. That increase in revenue combined with the increasing and lucrative operating profit margin has led to this phenomenal increase in Visa's earnings per share. And what did I share with you earlier about dividends? Dividends are supported by earnings. Look at where Visa's earnings have grown from $2 per share all the way up to $8.39 per share, more than 4x the level over the last decade. Increasing earnings lead to increasing dividends because, especially with Visa, the asset-light business model leaves a lot of cash for Visa to pay as dividends. And finally, Visa's stock price is not prohibitively expensive. It has all of those excellent characteristics I've been talking about in this video, and you're able to buy it at a forward price to earnings of just 23. There are so many hyped up stocks in the market today that are selling at juiced up valuations because they have good prospects, they have excellent prospects, and investors are excited about those stocks. While forgetting about excellent companies like Visa that have demonstrated phenomenal profitability, more than 4xing their earnings per share over the last decade with a strong competitive advantage, and they're selling at a forward price to earnings of 23. I like that. I like this stock, and I'm recommending it as my top dividend stock to buy in 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.